Okay, hi there. Welcome to a short series of videos revising aspects of the theory of the firm. In this video, we're going to be taking a look at business objectives. So what are the main business objectives that you need to revise for your A-level assessments and exams? Well, here's a list of 6 key objectives. I suppose the obvious one will be profit maximization, which is the default assumption of much of the standard theory of the firm. Obviously an assumption you should challenge and question whenever you can. A business might also be aiming not to maximise profit but also to minimise a loss, and in fact 1 and 2 have the same condition. Alternatives to profit maximisation include sales revenue maximisation, when marginal revenue is 0, sales maximisation, which is where a business is looking to achieve the highest possible output consistent with making at least normal profits. And then 5 and 6, quite interesting, corporate social responsibility, CSR, or as it's morphing into these days, environmental, social and governance targets, or ESG. Corporate social responsibility becoming an important issue, often seen as good for profitability in the long run. And something that hopefully you have covered in your economics, the idea of satisficing behaviour or constrained optimization. This is we'll go through this in a second or two, but this is where firms don't aim to maximise profits, but aiming to achieve, if you like, a satisfactory or sufficient rate of profit. Key point from the exam perspective is that the objectives of a business, the aims of a firm, will then influence their conduct, their day-to-day decisions about pricing, for example, which in turn will influence both the short run and the long run market outcomes. And those outcomes could be hugely important, including, for example, the consequences for social efficiency, social welfare and economic efficiency. Lots of stories in the news recently. Toyota has set a higher sales target. So clearly Toyota, the world's biggest car maker, actually, I think, overtook Volkswagen in 2020. But they're setting a target for the growth of sales. Now clearly sales and profits are linked. Successful sales should lift profits, but they're not necessarily automatically linked in a proportional way. And Unilever, one of the world's biggest consumer goods companies, they've just set a target of €1 billion in annual sales of plant-based foods. Unilever, responsible for products from Ben & Jerry's to Hellmann's mayonnaise and Magnum ice cream, they have a sales growth target of, I think, between 3 to 5% annual growth in global sales across their product range. They've actually got rid of quite a few products in recent times as they look to kind of narrow down their product range and focus on the future. This is quite an interesting case study. I've produced a video on BrewDog, one of my favourite companies, that is quite strong, I think, on corporate social responsibility. The BrewDog Street Dog project. Whenever a team member at BrewDog gets a puppy or adopts a dog, they get a fully paid week off to help the new family member settle in, and that's taken many dogs off the streets. BrewDog is a living wage employer. They have a profit sharing agreement with their team members. They've just bought over 2,000 acres of forest in the Scottish Highlands to create the BrewDog Forest. So basically, the more beer they sell, the more they'll plant in terms of taking carbon out of the air. They aim to be a carbon negative beer manufacturer. Their brewery in Scotland runs on renewable energy, and of course they pivoted very quickly during the pandemic to provide hand sanitizer for hospitals, and also recently canned water for people working on the vaccination programs. So CSR really quite important as an objective. It's worth noting also, I think, the role of activist shareholders in trying to lobby for changes to corporate boards and objectives. So here we have Danone, one of the world's biggest food makers. You probably know it from their yogurts and things, and bottled water. I think they've got the Evian brand. They're being pursued and pushed by some activist shareholders who think they should be changing their objectives. And an article from the FT in March 2021, half of all FTSE 100 companies now link executive pay in some shape or form to ESG targets, environment, sustainability and other targets. These are the key ones you need to know for A-level. It's really important you are absolutely bang up to date to know your key conditions. Profit maximisation is where marginal revenue meets marginal cost. Revenue maximisation is where the marginal revenue is zero. Sales maximisation is where average revenue equals average cost, the break-even point. And satisficing involves the owners of a business setting minimum acceptable levels of achievement of either revenue or operating profits. So these are the ones you need to know and the condition for each. So how do we show these objectives on cost and revenue diagrams? Well, let's go through them. Here's the profit maximisation diagram for a firm in imperfect competition, downward sloping average and marginal revenue curve, and profits are maximised at output Q1, where marginal revenue equals marginal cost. P1 is the price they can charge, C1 is the average cost, so the shaded area shows total profit. In a similar way, profits are maximised when marginal profit is zero. Now, marginal profit is marginal revenue minus marginal cost. It's the profit from the next unit produced and sold. Providing marginal profit is positive, then total profits will be going up. But once marginal profit becomes negative, then profits are falling. So you maximise profit where marginal revenue is zero. Sales revenue maximisation is the point where the marginal revenue curve or line hits the x-axis. So revenue maximisation is where marginal revenue is zero. What is the price elasticity of demand at the price and output where MR equals zero? Well, the answer is it's 1. Halfway down the demand curve, at that point there's a point elasticity of demand of -1. Unitary price elasticity of demand. So when it comes to revenue maximisation, you maximise revenue halfway down a downward sloping demand curve. Sales maximisation is a higher output level. This is where the firm will produce the maximum output they can consistent with achieving at least normal profit. So it's the intersection between the average cost and the average revenue curve at output Q1 there. Often means a lower price than the profit maximisation point. Now, satisficing, well, there's no unique satisficing equilibrium. All depends on the objectives of the firms, the objectives of managers versus shareholders, and also the degree of contestability in the market. But P2 and output Q2 is a possible price and output. It's to the right of the profit maximising output. It's a lower price. They're still making profit, but they're not maximising profit. Although at a higher output Q2, of course, they'd have a bigger market share. When it comes to drawing diagrams, don't forget to develop your diagrams. Obviously, we're looking here at different objectives, but for example, you might be asked to talk about the factors affecting profitability, and therefore you'd be looking to shift at least one of the cost or the revenue curves to show the impact on profit. Why might a firm choose alternative objectives to profit maximisation? Well, there are various reasons why firms may not necessarily maximise their profits, and the key one, I suppose, is that oftentimes the people who are making the decisions in firms, aka the managers, are not necessarily the owners of a firm, and the aims of managers may differ from that of the equity shareholders. And we call this the principal agent problem. I shall explain that in a second, but essentially the owners of the company may not be able to observe day to day what the managers are doing. Second reason for departing from profit max is that businesses are looking to survive during a recession, for example, or a pandemic. They may have some surplus stock they want to get rid of, or their cash flow could be draining away. They need to cut prices, sacrifice profit just to improve their cash flow. And crucially, often businesses want to grow. They want to grow their market share. They want to achieve market dominance, and that might involve a departure away from short-term profit maximisation. I think the key point is that businesses are nearly always very complex organisations, and they have different stakeholders. So therefore, the assumption of a single objective is highly unrealistic and highly restrictive. All businesses operate with bounded rationality, the work of Herbert Seymour. They can't operate in a purely rational, maximising way. It's just not possible. And businesses have stakeholders. Stakeholders, anybody, or groups, in fact, with a vested interest in the activities and the decisions taken by a business. And the stakeholders here, from managers to employees to suppliers to customers to government and the wider community, they don't necessarily own a business. The principal agent problem is the idea that there could be a gap between the aims of managers and the owners. In small businesses, the owners are typically managers, so they oversee the operational and strategic decisions. And the owners have a strong interest in profit maximisation because it's the basis of their wealth. The principal agent problem exists when the owners of a business, we call them the principals, and they've invested equity in the business. They hand over the control of the day-to-day running of a business to managers. We call those agents. And the two parties' objectives may not necessarily be aligned. And of course, it's not easy to observe directly what the managers are doing. The principal agent problem is essentially an information problem, an asymmetric information issue, where the owners of a firm cannot observe directly the day-to-day decisions of the management of a business. So we've been through what are some of the key objectives of businesses, some of the key diagrams, but do please be aware of the principal agent problem and the fact that oftentimes the people running a business don't necessarily have the same objectives as the people who own the business. In the next video on this revision series, we're going to be looking at the shut down decision.